Hey everyone, and welcome to The Explainer. We're jumping right in today because we are breaking down a seriously fascinating blueprint to multi-generational wealth. We're drawing directly from a panel of heavy-hitting financial experts, folks who specialize in real estate, business funding, credit leveraging, and structuring assets. If you've ever found yourself wondering how the wealthy actually build and, more importantly, keep their money, well, you're exactly where you need to be.
So let's kick things off with a pretty high-stakes thought experiment from our sources. Close your eyes for a second and imagine it's New Year's Eve 2030. The ball drops, a whole new decade kicks off, but you're waking up to a totally new financial reality. Based on the experts' projections, the average single-family home in certain markets could be sitting anywhere from $600,000 to $800,000. Multifamily properties? Try upwards of $1 to $1.5 million. And average rents are projected to jump to a staggering $3,500 to $4,000 a month. That is huge. So the real question we have to ask ourselves is, with exactly 4 years to get ready, are you financially prepared for that future?
Okay, let's dive into this roadmap the experts have laid out to make sure you are absolutely ready for that 2030 reality. First, plugging your financial leaks. Second, mastering your credit score. Third, securing business funding. Fourth, the power of real estate. And finally, number 5, multi-generational wealth and protection.
All right, step 1, plugging your financial leaks. You've really got to watch out for the income illusion. Earning a massive income literally won't save you if you're just pouring it into a financial bucket that's completely full of holes.
To achieve true control over your cash flow and actually patch up those holes, it takes some serious discipline. The exact budget breakdown suggested by the experts is pretty straightforward. Allocate 50% of your income to the essentials, housing, food, that sort of thing. Then, strictly cap your lifestyle and giving at 20%. That leaves a full 30% dedicated purely to wealth building. And here's the kicker. You absolutely have to commit to that 30% before you start indulging in any lifestyle spending. You want to make sure your money is planted in fertile soil first. Now, this brings us to a really crucial mindset shift. We need to understand the fundamental difference between reckless debt and strategic leverage. Reckless debt is basically using credit to fund your lifestyle, right? Buying depreciating assets like flashy clothes or cars, stuff that's just pulling cash straight out of your pocket. Strategic leverage, on the other hand, is a whole different ballgame. That's using other people's money to acquire income-producing assets. You use the debt to get the asset, and then, here's the magic, the asset's income pays off the debt for you.
Moving right along to Section 2, mastering your credit score, or as the experts put it, building your collateral. Because let's be real, to use other people's money, the bank actually has to trust you first. Your character, your reputation, and a tightly managed credit utilization rate, those are your primary collateral.
Let's walk step by step through this timeline, taking you from entry-level credit all the way to a highly respected status. So at month 0, you might be what's called a Tier 5 borrower. Maybe you've got a 680 to 690 score using secured builder accounts. By month 6, your one and only focus is building a 100% flawless payment history, because that alone makes up 35% of your score. Hitting month 12, you acquire your first primary trade line. This is an account fully in your own name to prove you can handle it independently. Fast forward to month 24 and boom, you've reached an elite Tier 1 profile. We're talking a 760-plus score, multiple $30,000 limits, all while keeping your utilization safely under 30%.
Which leads us to Section 3, securing business funding through corporate entity setup. The sources are very clear on this. To access serious capital, you have to transition from just being a personal identity into becoming a legitimate corporate entity.
And honestly, getting this done is incredibly simple. Step 1, secure your business name. Step 2, set up your business address and phone number. And hey, you can even just use your own cell phone to start. Step 3, hop online and register for a free EIN on irs.gov. And finally, Step 4, just pay the small fee to complete your state registration certificate. By literally just ticking off these 4 straightforward bureaucratic steps, you've transformed yourself into a limited liability corporation with a legal shield.
But, and this is a big but, just opening the account isn't going to cut it. You've got to master what's called seasoning. The experts point out that by systematically depositing $10,000 over time and just letting it sit there for more than 45 days, you officially become a low-risk borrower in the bank's eyes. You're intentionally building relationships with credit unions and conventional banks. That way, when you actually need access to major business lines of credit, they're looking at you as a proven, reliable partner. And that capital preps us for Section 4, the power of real estate, the ultimate tool for creating generational assets.
The experts state that over half of the entire world's wealth is generated through real estate. Let that sink in. It is absolutely the best vehicle for turning your business capital into long-term generational wealth.
Now, when we're dealing with real estate funding, you really have to master the 4 C's: credit, capital, collateral, and capacity. Just look at the breakdown. A conventional loan is pretty strict, usually requiring a 700-plus credit score, 5% down, and a tight 45% debt-to-income or DTI ratio. But look at the FHA loan. It's backed by the government and offers incredibly accessible leverage. We're talking getting in with just a 580 credit score, only 3.5% down, and a much higher capacity, allowing up to a 56% DTI.
Now, what's really interesting about this slide is how you continue to scale once your personal debt-to-income is totally maxed out. Enter the DSCR, or Debt Service Coverage Ratio loan. This specific program relies almost entirely on the asset's performance, not your personal income. Think about it. If the rental income coming in covers the property's mortgage debt, the loan is serviced, and boom, you qualify. It is an absolute game changer for serious investors trying to scale up.
The reason this asset class is so unparalleled is because real estate literally pays you in 5 simultaneous ways. First up, you've got cash flow coming in every single month. Second, steady market appreciation over time. Third is loan paydown, meaning your tenants are the ones actually paying off your debt. Fourth, you get major tax advantages like depreciation or using the 1031 exchange to legally defer capital gains. And fifth is strategic leverage, or what the sources playfully called charging it to the game, where you borrow against your own equity to go out and buy even more assets.
All right, we finally reached the roof of our financial house. Section 5, multi-generational wealth and protection. Because, listen, once you build all these incredible assets, the system can absolutely take them right back if they aren't structurally protected.
To build that protection, the experts emphasize leveraging 3 specific forms of insurance. Term insurance gives you pure coverage to wipe out mortgages if something tragic happens to you. Whole life insurance is there to build steady cash value over your entire life. And then there's Indexed Universal Life, or IUL, which is tied to the stock market's gains but protects you from suffering its losses. By using premium financing and cash value insurance, wealthy individuals literally become their own banks. They just borrow against their own policies to buy real estate independently. Pretty wild, right?
Now, imagine you buy all this real estate, but you failed to put it into a trust. Your family could be facing a massive 3 to 6% drain on the entire estate's value and upfront probate fees. And that's just so a judge can tell them how to distribute your assets. Setting up a trust legally bypasses this massive drain, locking your assets into a protected entity so you essentially control everything but own nothing.
Which brings us to our final thought for today. For all the talk we've done about LLCs, high-yield accounts, and real estate leverage, it all traces right back to the human element. The experts reference Proverbs 22:1, which states, "A good name needs to be treasured over riches." Your character, your reputation, and how you honor your commitments, that is the foundational collateral that makes every bit of this wealth building possible. So as we look down the barrel toward that 2030 time machine deadline, are you ready to start protecting your name, plugging those financial leaks, and building your own multi-generational legacy today?